let's jump right into it. So, today we're going to talk about the Federal Reserve. Now, what is the Federal Reserve? So, to answer this, what better place to go than to the Federal Reserve itself? So, they define themselves as the central bank of the United States. It performs five general functions to promote the effective operation of the U.S. economy and, more generally, the public interest. So, the Federal Reserve conducts the nation's monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates in the U.S. economy. It promotes the stability of the financial system and seeks to minimize and contain systematic risks through active monitoring and engagement in the U.S. and abroad. It promotes the safety and soundness of individual financial institutions and monitors the impact on the financial system as a whole. It fosters payments and settles systems safely and efficiently through services to the banking industry and the U.S. government that facilitate U.S. dollar transactions and payments. And finally, it promotes consumer protection and community development through consumer focused supervision and examination. It also does this through research analysis of emerging consumer issues and trends, community economic development activities, and the administration of consumer laws. So, the way I look at it in very simple terms is the Fed is like a life coach for the US economy.
I want to give a brief rundown of the history of the Fed and just central banking and monetary policy in America in general, because it is pretty important, and I'm going to come back to a lot of it later. So, to finance the American Revolution, the Continental Congress printed the new nation's first paper money, known as Continentals. The fiat money notes were issued in such quantities that they led to inflation, which the amount at first rapidly accelerated as the war progressed. Eventually, people lost faith in the notes entirely, and the phrase "now worth a continental" came to be used frequently, which just meant it was completely worthless. And I forgot to add, all of the history stuff is coming from the Fed's website as well. So then Congress established the first Bank of the United States in 1971. When the bank's 20-year charter expired in 1811, Congress refused to renew it by one vote. By 1816, the political climate was once again leaning towards a central bank by a narrow margin. Congress agreed to charter the second Bank of the United States. But when Andrew Jackson, a central bank foe, was elected president in 1828, he vowed to kill it. His attack on its banker-controlled power touched a popular nerve with Americans, and the second bank's charter expired in 1836, and it was not renewed. Later on, state-chartered banks and unchartered free banks took hold, and they were issuing their own notes redeemable in gold or spices. The bank also began offering demand deposits to enhance commerce. This helped business quite a lot, and during the Civil War, the National Banking Act of 1863 was passed, providing nationally chartered banks whose circulating notes had to be backed by U.S. government securities. An amendment to the act required taxation on the state banknotes, but not the national banknotes, effectively creating a uniform currency for the nation. Despite this, bank runs and financial panics continued to plague the country, or the economy. In 1893, a banking panic triggered the worst depression in the United States had ever seen, and the economy stabilized only after the intervention of financial mogul J.P. Morgan. It was clear that the nation's banking and financial system needed some serious attention. Once again, in 1907, it was J.P. Morgan who ultimately forced the government into acting on the central banking system it had been considering off and on for almost a century. During the bank panic of 1907, Wall Street turned to J.P. Morgan to steer the country through the crisis that was threatening to push the economy over the edge into a full crash and depression. Morgan was able to convene all principal players in the stock market at his mansion and command all their capital to flood the system, thus floating the banks that in turn helped to float the businesses until the panics passed. So the Aldrich-Vreeland Act of 1908 was an immediate response to the panic of 1907, provided the emergency currency issues during the crisis. It also established the National Monetary Commission to search for a long-term solution to the nation's banking and financial problems. So under the leadership of Senator Nelson Aldrich, the commission developed a banker-controlled plan. Williams, Jennings, Bryan, and other progressives fiercely attacked the plan. They wanted a central bank under public, not banker control. And in 1912 election of Democrat Woodrow Wilson killed Aldrich's plan, but the stage was set for the emergence of a decentralized central bank. So by November 16th, 1914, the central bank idea had been agreed upon, and 12 cities have been chosen as sites for regional reserve banks that were open for business. But this was just as hostilities erupted into World War I. During the 20s, the Fed began using an open market operations as a monetary policy tool, and this also elevated the stature of the Fed by promoting relations with other central banks, especially the Bank of England. Obviously, then the Great Depression happened, and there was a good amount of anger and blame thrown at the Fed for not addressing the amount of speculative investing. So, in reaction to the Great Depression, Congress passed the Banking Act of 1933, better known as the Glass-Steagall Act, calling for the separation of commercial investment banking, requiring use of government securities as collateral for Federal Reserve notes. The act also established the Federal Deposit Insurance Company, which placed on open market operations under the Fed and required bank holding companies to be examined by the Fed, a practice which would have profound future implications as holding companies became a prevalent structure for banks over time. Also part of this massive reforms taking place, President Roosevelt recalled all gold and silver certificates, which effectively ended the use of any other gold or any other metallic standard. Following World War II, the Employment Act added the goal of promising maximum employment to the list of Fed responsibilities. The Federal Reserve System formally committed to maintaining a low interest rate peg on the government bonds in 1942. After fierce debate between the Fed and the Treasury for control over interest rates, the U.S. monetary policy, their dispute was settled, resulting in an agreement known as the Treasury-Fed Accord. This eliminated the obligation of the Fed to monetize the debt of the Treasury at a fixed rate. It became essential for the independence of central banking and how monetary policy is pursued by the Fed, the Federal Reserve today. In the 70s, inflation skyrocketed as producer and consumer prices rose, oil prices soared, and the federal deficit more than doubled. In 1979, when Paul Volcker was sworn in as Fed chairman, drastic action needed to break the inflation stranglehold on the U.S. economy. Volcker's leadership as Fed chairman during the 80s, though painful in the short term, was successful in overall bringing the double-digit inflation under control. Through the 90s, the Fed used monetary policy on a number of occasions, including the credit crunch of the early 90s and the Russian default on government securities, to keep potential financial problems from adversely affecting the real economy. The decade was marked by generally declining inflation and the longest peacetime economic expansion in the history. So good job, Fed. The effectiveness of the Federal Reserve as a central bank was put to the test, though, on 9/11 as the terrorist attacks on New York, Washington, and Pennsylvania disrupted U.S. financial markets. The Fed issued a short statement reminiscent of its announcement in 1987. The quote was, "The Federal Reserve System is open and operating. The discount window is available to meet liquidity needs." In the days that followed, the Fed lowered interest rates and loaned more than $45 billion to financial institutions in order to provide stability to the U.S. economy. By the end of September, Fed lending had returned to pre-September 11th levels, and potential liquidity crunch had been averted. During the early 2000s, low mortgage rates and expanded access to credit made homeownership more possible, increasing the demand for house and driving up house prices. The housing boom got a boost from increased securitization of mortgage, a process in which mortgages were bundled together into securities that traded in financial markets. Securitization of riskier mortgages expanded rapidly, including subprime mortgages made to borrowers with poor credit records, which would eventually lead to the 2008 financial crisis. But we'll stop there for the sake of time, and still a lot of debate on different parts in more the last decade with the Federal Reserve. But it's important to note that pretty much every country has some form of central bank, which really highlights how important and how like they're just like one of the foundations of our society. It's one of those things that when people look at like what the metrics of making it, a nation, it's often bunched in with them. Most of the other countries' central banks fill a similar role as the Fed and they are not without controversies. But most of the major controversies come from more aggressive handling of monetary policy during like major economic problems in other countries. Okay, so now that we have all this information, let's break down why a system like the Fed is important and some arguments for and against it. So, people who have a stricter interpretation of the Constitution believe that it is unconstitutional because the power to create a central bank is not explicitly stated, therefore, it is unconstitutional. Another argument is that because many of the positions in the Fed are not elected officials, it should be removed. So, like all 12 regional federal bank reserves or reserve banks are overseen by 7 governors who sit on the board of governors of the Federal Reserve. The independent board and its chair are appointed by the U.S. president and confirmed by the Senate, but the presidents of the regional banks, however, are appointed by a board of directors comprised of mostly private sector representatives. Detractors argue that officials typically have close ties to the banks they oversee and are therefore more likely to look the other way when policing bad behavior. Personally, I do agree that there's a problem, but I don't think that the solution to that is just removing the Fed entirely. That is more of an argument for reform rather than abolishing it. So my argument more boils down to the Fed is responsible for like so many things for suggesting interest rates. By setting target interest rates at which banks lend to each other overnight in order to maintain and reserve requirements, which is known as the federal funds rate. They affect exchange rates through the foreign exchange trading desk of the New York, where the Fed buys dollars and sells the foreign currency. Conversely, to reduce the value of the dollar, it sells dollars and buys the foreign currency. It also affects the supply of money in an effort to help the economy through uh, different climates. It also does open market operations, which is buying and selling bonds to regulate the flow of money. It sets the minimum reserve requirements, which is the proportion of banks' deposit that bank must hold in cash, either in their vaults or on deposit at the central bank. It sets changes in minimum lending rates. So all of these functions are objectively required for an economy to be succeed. A economy cannot operate at its like maximum potential without these things. If we did not have the Fed, we would need some form of institution to do this. So like before the Fed, we had already had some of this with like the different banks of America being used and like being dependent on J.P. Morgan to get the economy through rocky situations. And I feel like the people who don't support the Fed wouldn't find themselves preferring those options either. In more recent history, the Fed has demonstrated their effectiveness in avoiding an economic crisis with their response to 9/11. And many more times, the Federal Reserve has been less successful, but those have always been due more towards the decisions people in charge have made and not the structure and the rules of the institution itself. The Fed for the 9/11 example, the Fed specifically, like alternatives to the Fed would not be able to act that quickly and roll out measures to help stabilize the economy that fast, which is like just demonstrates how necessary it is to be successful as economy. The Fed is also incredibly important just because of the sheer amount of information they take in. This allows them to to supervise the economy, as explained by Richard Spillicothen, I believe. He said that supervision is a way not only to learn about what's going on in the financial system, what are the emerging points of systematic vulnerability, principal emerging weakness, but it also gives the central bank an important role in settling financial and macroprudential policies and all of that contributes to its broader financial stability responsibilities. All of the information also gives the Fed a unique perspective compared to other regulators like the Treasury. So any alternative to the Fed would not have anywhere near this level of information the Fed has now. So that like they just wouldn't be able to give the perspective and the advice that the Fed is able to give currently. Some also argue that we should have monetary policy tied to the government, but as Donald Cohn, a former, I believe, vice chair for the Fed, explains, there tends to be an inflation bias to central banking when monetary policy is closely tied to or closely controlled in the political process. So, imagine that monetary policies would look like in the next 12 months or so, with midterms coming up, if Congress controlled monetary policy. For one, it would probably take months for anything to get passed based off just how Congress is right now, and the interest rates would be focused more to help the reelection of congressmen rather than actually helping the economy. So Cohn also explains the problem if we were to conduct monetary policy by pegging it to a commodity like gold or silver, we'd have problems that the Fed was made to solve. So he explains that periodic bank panics occurred under the gold standard, and the Fed was founded to help deal with those. And when you're at the mercy of the supply of gold in the world and the distribution among countries, you get situations as had occurred in the 1920s when some countries accumulated large volumes of gold and they put downward pressure on the price levels of other countries that didn't have those large quantities of gold. It wasn't until the U.S. went off the gold standard that we were able to begin emerging from the Great Depression. So this really shows it's just the argument that to peg it back to a commodity or a metal is kind of silly, just because it was such a problem to have it that way in the first place that was part of why the Fed was created. So basically, all of this adds up to just there are some legitimate arguments for reform, but